Okay, I'm just going to do the roll call. Landon Moore.
Present.
Mr. Holly is out. Mark Gardner.
Here.
Karen. Stephanie out. Mr. Cubby.
Here.
And Joel Hawkins. And Mr. Challenger is here.
Here.
I'm here. Miss Wright is not here. Okay. We have three official members here.
So not a quorum. We need
Not
four.
a quorum.
All right. So we will approve the minutes at the next meeting. OPEB Trust. What's the latest?
Okay. You will see in your package that I pulled down the balances as of May 4th, and it was $7,240,986. And you'll also note that the city made a $500,000 contribution over the last month or so. And you'll see that showing up in the detail. So the cost basis in the OPEB account is $5,482,982.23. So, and as you know, we're in Portfolio 1. And if there's any questions, I'll try to answer them.
They don't show any like the investment returns on the
No.
statements.
No, there were no reports available at this point. We probably will be able to get their reports at the next meeting.
I forget. Do you know offhand? Do they post their post things online? Like if they have a website, you can just go look at the portfolio.
They don't do everything that I would like to see, so I usually call them and ask for it. In fact, I will send them an email, see what I can find.
Okay. I guess we can skip the review of retirements.
Yes.
We don't have Miss Wright here. Should we go through this reconciliation of market value before Greystone?
I think that everyone should have it in their package. It's right behind the OPEB material. And he's broken down to fire and police on one page. The next page is supplemental, and then he's got a summary sheet. And just to kind of recap it, for June 30th, 21, we were in total 85.73% funded. As of September 30th, we were a little less, 83.81% funded. December 31st, 85.79, and as of March 31st, 78. So you're beginning to see the decline in market value, but of course we're paying out money all the time as well. And I thought it was interesting, and that's the kind of thing I'd like to see on the June 7th, is if you look at 2021 at the top there, it's sort of, and maybe we can do a calendar 2021 to make it a little more meaningful, or the one ending in March, or later if Andre can do it. But just see the total of benefits paid of $30.3 million. Mm-hmm. And contributions from the city. And I was just looking, I think the city has been contributing more than the actuarial requirement. Yep. And part of that was because of the savings we had on the refunding of the bonds, but I told them to remember to at least reduce that back to the actuarial requirement.
So this, it looks like since 2021 fiscal year, and it's been 2.7 million per quarter.
Yes.
That sounds about right. 'Cause
Yeah.
the actuarial amount was like 11 million or something.
Well, it's actually a little less than 8 million based on the last actuarial study.
Oh, so the 2.7 is more than,
Yeah, more than required by the actuarial required, the ARC.
well, I think us board members are okay with that.
No, I understand, and I think that the city management wants to see the liability reduced and wants to keep giving more.
Yeah, it's not a, I mean, I have no idea what all the competing needs are of the city, but it's not a bad place to
Yeah.
put the money to fund this
Well,
liability.
if you have trouble sleeping, watch the last city council meeting and you will see the competing needs.
Indeed. And I see them daily, too. I don't sit around and look at police and make a circle around myself. I try to be part of the city, and some of the things that happen with utilities and public works and some of them are absolutely staggering. And you wake up, you're on the city council, and you're faced with it's a lot more to run in the city than just us.
But we will certainly do our best, but rest assured the city will always make the required contribution based on the ARC, the actuarially determined amount. Because they know that it's important not only to retirees, but really for prudent fiscal management.
Okay. Anybody else have any questions on this? All right, I guess.
If I can throw in, it stays on the forefront with the retirees, the percentage of the funding. They look at that as the forecast for, am I okay? That's all the questions I get. Where's the funding percentage?
There is money there to make the payments, and what, as you know, we project off until the last person dies, what that liability is. So looking at the immediate need, there is plenty of money to make payments, and that's the thing that a lot of people don't get. They get concerned when they see a lower than 100%, but that's a that's a number cruncher number. It's not realistic for today. If you look at the balances of over $200 million, that's the number they need to pay attention to. We need roughly $30 million a year. The city's putting in money. We're making money, usually. So there is sufficient money to make payments. We're just looking at the next 30 years or whatever the lifespan is of the last person.
Say it's funded at a healthy percentage at this point, even with the, well, I don't know what April numbers look like. It's going to look worse than
Yes.
than March, but you know, over the last several years, the funded status has improved quite a bit from where it was. So we've been headed in the right direction. You know, markets, as Brian will say, don't just always go up. So with that, if there's no other questions on this, no other comments.
I did want to just remind everyone, the city issued bonds to provide funding to the system to invest. The city is making the debt service payment on those bonds, which is about $11 million a year. So that's significant commitment of the city's general fund to fund this program. And I will also add that I was doing a comparison to other cities recently, and saw where the city of Norfolk issued pension obligation bonds in June of 2021. So,
Should have done it now.
yeah.
Do you know offhand what the term is on those bonds? How long they were? Like 20-year bonds or something?
I think it was 25. You were pretty sure it was longer than the typical 20.
Do we know how much investment income we've earned off of that since we issued those bonds? I know we know since Brian and that group took over, but that's...
We've done well. That's a good question.
Yeah, so the number we have since we took over in terms of the dollars, now this would include the pension obligation bond proceeds, but it would also include what was in the trust fund prior to that.
Yeah.
Although, the bonds were issued when?
2013.
2013. Okay, so we started in 2016. At any rate, 94.5 million in dollars due to investment returns.
Is that since 17 or 13, Brian?
Since April of 2016.
Okay.
So that's against 11 million a year, 60-something million of
Yeah,
Yeah.
that's significant.
interest, I guess.
Better off.
By far.
Yeah.
It was a good idea, good move.
What is the coupon on those, like 5% or something? 5.25%?
Three.
I'm sure it's less than that because it's been refunded when the market was low. So,
Yeah.
Right.
Well, if it's 200 million and it's 5%, isn't that 10 million a year in interest?
well, in interest, but we're making principal and interest.
Oh,
Yeah.
of course.
Yeah.
It's not it's amortizing. Okay.
Yeah.
We do, I don't know, a lot of bullet.
Good questions, and we'll see if we can't get that more precise for you.
Well, that would seem to me to be a good piece of information for the
I
meeting with
think that
council.
is excellent, yeah. Good, good.
All right. Brian and Jim, I think it's your turn.
Great. Good to be with you.
Well, we could make your meeting short. We've got
Welcome
nothing. We've got nothing to say. There's nothing going on. See you next time.
You just don't want to say anything.
Were you last here in February?
Correct.
March.
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 I think it
March
was
10th.
10th or 11th.
Okay, so because we missed the February meeting because of something
Well-
I
Yeah.
can't remember.
Because of the virtual versus in person.
But there was
and-
concern about the
Omicron.
Omicron.
Wait 1 month.
Yep.
Yeah.
Um,
Look at the
March
graph, that's
10th.
when it peaked, February, and
Yeah.
came down in March.
so that was right before. When did the war start?
Just
End of
before that,
February.
just
February.
before that.
Okay,
We
so that
talked
had
about the
already
war at the last
Yeah.
meeting.
Okay. Well, actually, we're not going to talk much about the war because there's plenty of other things to talk about. So I'm going to speak from here. This is as of March 31st. I'm going to give you an update through yesterday. Obviously, a lot's transpired from the end of the first quarter. But maybe before I get into that, I'll just to sort of set the stage. There's a saying that's commonly viewed as a curse, and it is, "May you live in interesting times." And the reason why everybody thinks it's a curse is because interesting times are sort of chaotic and exciting, not in the positive sense, but there's a lot going on. And so that's sort of the meaning behind that. And I tried to kind of fit what we're going through today maybe into this concept of interesting times, and there's a couple of things that stuck out to me. Number one, inflation. Inflation's running, well, we just had an inflation number yesterday. Prior to that, it was running at 8.5% a year. Yesterday's number was more like 8.3%, so let's call it somewhere between 8 and 8.5. That's headline CPI. It's the worst in 40 years. And the interesting thing about inflation, we may have talked about this last time, but the interesting thing about the call it 8.5% number, is that we actually think it understates what people are actually feeling, because over the years, the government, it's an organization called the Bureau of Labor Statistics that puts out the CPI. They've made changes to the way they calculate CPI. And so if we calculated what's going on today the way they used to calculate it back in the 1980s, inflation isn't 8.5%, it's probably double that. So what we're all feeling as we go to the grocery store, as we go to the gas station to fill up our tanks, is not like 8.5%, it's a lot worse. Second thing, because of the heightened levels of inflation and because interest rates have been rising based on what the Federal Reserve is doing, increasing short-term interest rates, they talked about reducing the size of their balance sheet. Jim's going to talk about a lot of this stuff in a bit. The bond market is down 10% this year. This is roughly through the end of April. It's the worst bond market in 50 years. And if we looked at just U.S. Treasury bonds and we just picked on the 10-year Treasury bond, we've had a massive move in interest rates. Last year we ended the year at roughly a 1.5% yield. A couple of days ago, we got awfully close to 3%. That is a very large move in yields. The 10-year Treasury bond through the end of April is down 11.5% this year. I saw a chart that was produced by Deutsche Bank that looked at every calendar year in the first 4 months return, so the start of every calendar year for the 10-year Treasury bond. So we're down 11.5%. It is the worst start to any calendar year since, I wrote this down, 1788. Obviously, we didn't have Treasury bonds back then, but we issued bonds to finance the American Revolution. That was the year before George Washington became president. To say these are unprecedented times is an understatement. Now, what's going on with stocks? The S&P 500 is down for the year about 17%. It's down 13% for the month of, so far in the second quarter, so for the month of April and the first week or so of May. Small cap stocks are down 23% on the year. Developed non-US markets are down 16. Emerging markets are down 17. So, interesting times indeed. These are, in some sense, unprecedented times, but it's also, I think, important to put what we're going through right now into a little bit of context. And we'll get into the portfolio in a minute, but down 17% on the S&P. Okay, it's a big number. Nobody likes to feel that. Nobody likes to experience that. Last year, the S&P was up 29%. So we haven't given back all of the gains we had last year. Now, in some of the other markets, we have. But we've had, to Landon's point, markets don't always go up. This is true. In fact, they go down more frequently than any of the fancy models will tell you they do. But we've had a very long period of time where we've had very, very strong capital market returns. We've benefited from that. $94 million over the last 6 years says we've benefited from that. We're going through a period right now for a lot of reasons, and we'll get into it. But things are pulling back, and we think there's the possibility that we could continue to see more downside. But as each day goes by, we get closer to that bottom. And what gives us a little bit of comfort, I would say, in the early part of May, is that everything is not going down. Bonds have started to rally. And that provides some support and some ballast to the portfolio that we hadn't had this year up until the last few days. So typically, you know, when you put a portfolio together of, in broad terms, stocks and bonds, they don't always move in the same direction. But we've moved in the same direction for the first 4 months of the year, the early part of May. That relationship between those two looks like maybe, hopefully, starting to return to more normal, where when one does bad, the other does reasonably well. So with that, I'm going to turn it over to Jim. I'm going to come back and talk about the portfolio, how all this relates to not only the first quarter, but give you an update as to what's going on in the second quarter. But Jim's going to update, some of the numbers we talked about last time we were here in March about somewhat our concerns for the equity markets and kind of give you maybe some new insights into what we're thinking there.
Okay, it's great to be with you all today. Thank you for being here. Can I ask you please to turn to page 8? I was just reviewing the minutes quickly here, and this is from our March meeting. Some of the notes: inflation will be persistent. It will be hard to make money this year. Indices lower, 20% correction possible. Greystone expects more downside. And as I read these, I think our job really is not to sugarcoat where we're at. It's to tell you exactly where we're at and what our expectations are. So not a lot has changed since we were here in March, but a few things have. So I want to go through some of these slides quickly and focus on what has actually changed. Brian took us back to the American Revolution, so I don't need to spend a lot of time on slide 8 to talking about what's changed. But certainly we have a war that has erupted. Gas prices are escalating. We have rising inflation everywhere. We'll look at some of these numbers more closely. And we have the start of a new rate cycle for the Fed. So that's a pretty aggressive backdrop for financial assets to deal with. If I can draw your attention to slide 9 for a moment, the upper left, I'm just going to look at some of the measures of inflation for a moment. The upper left, the dark blue line, CPI, ranging between 8.3, 8.5%. Either way, it's a 40-year high in inflation. Commodity prices up 30% year over year. So pressure everywhere across the system. The bottom left, we're looking at energy prices, oil, crude oil to be specific, which is the dark blue line, and then the light blue line is consumer confidence. While not a perfect correlation, one of the things that we can see is there is a reasonable correlation that when these oil prices, gas prices start to spike the way they're spiking, consumer confidence starts to roll over. And that's really what we're starting to see here. And energy costs represent roughly 5% of disposable income for the consumer. And for the lower economic end of the population, of course, it's even more pronounced. And that's really where the squeeze is coming. We get upper right, we get some questions about the Ukraine's importance to exports, and we'll look at this a little bit more closely in just a few minutes. We'll see that the Ukraine exports about $11 billion of the cereals, as they're called, and that's the barley, the wheat, the maize. And Russia exports about $20 billion, so almost twice as much as the Ukraine. So it's certainly an area of concern and an area of focus. Those price increases are going to be substantial for a while. The bottom right is an area I want to spend a little bit of time focusing on, because I think it tells a story about what's happening in the capital markets. So these numbers are as of April 8th. They move around quite a bit, and what we're looking at here is the 2-year Treasury, 5 and 10 and 30-year. And if we focus on the 2-year for just a minute, I think yesterday it closed at right around 2.66%. If we look back to June of last year, that same U.S. Treasury 2-year yield was about 0.14, 14 basis points. So if we look at where we're at today versus the 2-year a year ago, it's up almost 19 times, almost 20x. And the Fed has just started its tightening campaign. It started with a 25 basis point increase, followed by a 50. And we've got a chart that lays out our views on that tightening campaign. So while the Fed is just getting started, the markets are incredibly turbulent. Bond prices are down, as Brian pointed out. Equities seem like a relentless sell-off at the moment. And it's really in anticipation of this cycle. And the bond market, to a great extent, has already done the Fed's heavy lifting by raising short-term interest rates, the 2-year Treasury, which is very sensitive to Fed policy, and the 10-year, it breached 3%, which is a really big move, a doubling from where it was about a year ago, 2.91%. So I guess if there's any good news is default rates remain really depressed. We haven't seen any concerns about defaults in bonds yet. Upper right slide, on slide 10, Brian covered this, but this is a little bit more granular. He's going to go through some of the performance of indices as well. But broadly speaking, this is just for the first quarter. There were no safe havens in the portfolio. So the fixed income portfolio really is traditionally the ballast, right? And we'll look at a performance of a traditional 60-40 portfolio in just a few minutes. But whether it's short-term fixed income, high quality down 3.5% for the quarter, high quality municipal bonds down 6.2%, or even worse, the 10-year U.S. Treasury down 7.4%. This next slide, slide 11. What is really concerning to the market? The market's well aware that the Fed will be tightening interest rates. Priced in 10 increases from the start of the tightening campaign. Well, the concern really is about a policy mistake. And when we talk about a policy mistake, we're really referring to excess tightening. So tightening, beginning the process too late, that results in excess tightening, which then results in a recession. That's really what's causing the market to create all this volatility. And let's look at the gap that's got to be closed here in the upper left for a second. So here we're looking at Fed funds rate, which is the part of that the Fed controls. So that's now, after 2 tightenings, it's now between, call it, the range is 0.75% and 1%. So slightly higher than what's illustrated here. But the CPI that Brian mentioned is now, call it 8.5%. So we've got a, call it 1% Fed funds rate, maybe a little bit lower, 8.5% inflation. That's a pretty significant gap to close. And there's general belief that those two numbers need to be closer to each other to finally see inflation start to roll over. So the Fed starts significantly behind the curve, very big gap between where the Fed funds rate is and where inflation is. And then if we look at unemployment at the very bottom of the slide, left side, we see that that is at 3.6%. So clearly full employment by most every economist definition. So there's room to tighten, but I think these two things really illustrate how far behind the curve the Fed really is. The bottom right is another area of focus for investors, and this is the Fed's balance sheet. The Fed has about $9 trillion on its balance sheet. Approximately $4.5 trillion of that came during the last pandemic cycle. So a very significant increase in the Fed's balance sheet. And the questions that investors want to know is, well, what's the Fed going to do with this balance sheet? And they provided us some guidance at the last Fed meeting, which was there'll be about $47.5 billion coming off the balance sheet in June, and then it'll be about $95 billion every month thereafter. That's not selling, that's just allowing these Treasury mortgage-backed securities, which kept mortgage rates low for a very long time by design, to mature. A little more complicated to mature than Treasury bills, and the rest will be U.S. Treasuries. The consensus is that that runoff is the equivalent to another 25 basis points of tightening. So what the Fed really wants is to orchestrate tighter financial conditions, and they're going to get that one way or the other. And that creates a very difficult backdrop for financial assets. Slide 12 is a a nice illustration on the bottom of what we expect at each of the upcoming Fed meetings going through the end of next year. Upper left, we're looking at retail sales excluding gas and the 3-month average. And we can see retail sales starting to roll over. These numbers move quickly, so the data gets stale. But there's an old saying that the cure for higher prices is higher prices, because it creates demand destruction. But ultimately, consumers will pull back because they refuse to pay these higher prices, or worse yet, they can't. And we're starting to see some of that. Bottom left, just to illustrate how much inflation has impacted the housing sector. Here we're looking at shelter costs. We're looking at the dark blue line is home prices up about 20%, and then rental rates also up about 20%. So if you're a new college graduate looking to get into the workforce, you find rent is almost out of your grasp, and certainly home buying is also almost out of your grasp. Mortgage rates, as of Saturday, the 30-year mortgage was 5.7%, and that's up from 2.9% 1 year ago. So the tightening campaign that the Fed is orchestrating in the capital markets is already finding its way into the real economy. Slide 14, we get some questions about Russia's share of the global commodities. This is upper left on slide 14. Russia's share of the global commodity production and food production is going to remain a very large concern. So yes, you can see that they have a major impact on the grains I talked about earlier, the oats and barley, wheat, etc. But also palladium, largest exporter of palladium, which is of course found in virtually every car in the catalytic converters. Bottom left, the EU does have a problem. 41% of the EU's gas comes from Russia, and that's going to have to find a way to be replaced. We've got some suggestions on the bottom right. Upper right is questions about Russia and sanctions relative to other countries in the world. And you can see Russia clearly is the most sanctioned country in the world, as you would expect. Slide 15. We do get a question about inversion of the yield curve. I think we touched upon this at our last meeting. And here we're looking at the 3 and 10 year. We also have definitions of what is a recession. If you're interested, it's 2 consecutive quarters of contraction followed by rising unemployment. Then we had a question about a bear market, which is just a 20% decline from peak. But moving back to the inversion of the curve, this is probably something that won't go away in the coming months. On the upper left, we're looking at the 10-year curve versus the 3-year. And just to refresh, a normal positive upward sloping curve is a healthy sign for the economy. So in my earlier example, the 2-year Treasury yield should be below the 10-year U.S. Treasury yield because you're taking more risk as you invest further out. There's more interest rate volatility in the 10-year compared to the 2-year. Normal, healthy curve. What we're referring to here is that the curve inverts and the 2 or 3-year Treasury curve yield is higher than the 10-year. And what that's signaling is long investors, the 10-year Treasury investors, saying, well, we expect the economy to slow as a result of all this Fed tightening. So in anticipation of that, we're willing to buy that 10-year Treasury, even though that yield is below the short end of the curve, that 2 or 3 year, and that's the inversion. So what you see on the left in those gray bars is when right around the curve inversion and the subsequent recession. So recessions have started 15 months after the last Fed hike on average. We don't know exactly when that's going to be. There's debate. We have a forecast, but markets are already suggesting maybe that's too aggressive. Supply chain gets fixed, inflation starts to roll over, maybe the Fed doesn't have to complete that that campaign that we've outlined on a prior slide. But what we do know on the bottom, very bottom of this slide, is the S&P 500 has peaked after the first rate hike, and the median is 41 months after that first rate hike. So that takes us through October of 25 as an example of when we might see a recession.
Can I just ask a question while we're here? So that 2 consecutive quarters of negative GDP is like, I guess, like the classic economics definition. But I've been hearing that that's not really, you could ask different people and they say that's not as important as some other factors of what, you just define as a recession. So we've already had 1 quarter of negative GDP. Why is no one saying that we're in the recession now, which we completely could be? And wouldn't that, if we are, call it a mini recession, and maybe people say, oh, it's 2 consecutive quarters of GDP negative, but we're not going to call it a recession for whatever reason. Hasn't it been, and I brought this up the other meeting, we did have an inversion in the curve for like a split second, I don't know, a year and a half or so, 2 years, or right before the pandemic. And wouldn't that, if you look at the history of when the yield curve reverts and when a recession, this would be about the time? That's sort of a lot that I said.
No, those are all good questions.
Why is no one talking about we're in the recession now?
Well, if we look back over time, economists almost never recognize you're actually in a recession when you're in a recession, right? And so that's the first thing. Second thing is the first quarter GDP was minus 1.4%. But it's pretty well believed that a lot of that was just accounting for trade and inventory adjustment. And if you look through that calculation, it was it's still a very healthy, strong quarter. So nobody's projecting this quarter or the next couple quarters to be negative. So it's very unlikely we're going to have a contraction of 2 quarters. And with respect to the inversion, you're right, we did have an inversion, but it was really brief. Was it a day or 2? And then is that trading noise or is that a real sustained inversion? I think most economists are saying interest rates can be pretty volatile, especially at this time in the cycle. And that didn't check the classic traditional box for an inversion.
Yeah, you only know that you're in a recession and when it's already happened.
Right.
So Q1, it was a government and inventory buildup, but the consumer, I guess, was still strong. But consumer sentiment's been really bad.
Yeah.
I don't know. I just think there might be a chance that this is the recession.
It could be,
But of course, I'm not an economist.
The curve inverted again, I think, in April, too. So we've had a couple. I'm always, I always chuckle when people say it's different this time. And I think it was Sir John Templeton said the 4 most dangerous words in investing are "it is different" or "it's different this time." And we all look for reasons why the past isn't going to repeat itself, and yet inevitably it does. Maybe not exactly, but I think somebody else said history rhymes with the past. Maybe not, verbatim. So. Look, it's one thing we look at. It's one thing we consider. I think in the first quarter GDP, I do think all of the decline was because we had much more imports than exports, and that reduces your GDP. But the mere fact that you have a lot more imports is reflective of the underlying demand that's in the economy. So we can't possibly continue to import at the levels we had in the first quarter. So I think that's why the expectation is we won't have another negative GDP print in the second quarter. But we could. And then they'll start talking about, well, it's technically a recession, but it's not really one. So I think the sort of our view and expectations for the typical recession are probably a couple of years down the road. Now, the market is going to react before we know we're in a recession. But to Jim's point, if the Fed tightens too much, they make a policy mistake, they bring about their recession sooner, well, then maybe what we're going through right now is a reflection of the fact that the economy is going to slow down much more substantially than anybody's thinking.
Lynn, I would argue that you are not alone in your thinking. And if we want to look at one sort of canary in the coal mine, we'd be looking at the price performance of bank stocks. They're hypersensitive to the strength of the U.S. economy. And one would expect that if short-term interest rates are going to move up the way we all anticipate, that those deposits, which have been sitting in the banks earning nothing for years, are about to become a source of income, because that spread is an important component to the bank's profitability and margins. And yet, what's the price performance of many of the bank stocks, right? Down 25–30%. It's concerning.
Up a lot too.
They were up, but if they weren't,
And usually banks do well in a rising rate environment, right?
yes.
They do, but not a flat and potentially inverted yield curve. So you got a little bit of a push and pull.
Normal curve,
Maybe
short rate.
inflation finally caught up with the consumer. I don't know. I'm like
So-
derailing the.
Well, you're not.
No.
I don't think you're alone in your concern, and it's part of the reason I let off my statements. Like we all know about the Fed tightening. There's no news here. There's no revelation. We talked about it at our last meeting. The market's fully priced it, but the market knows it. It's pricing in something more than the Fed tightening, which to Landon's point could be a slowdown of some sort. Which is exactly what the Fed's trying to engineer, is a slowdown. And will they engineer a soft landing? Pretty hard to tell at this point. Let me go through just two more slides, and I'll turn it back to Brian, because we want to go through the portfolio in some specificity with you today. So slide 16, this is it's an old slide, but I'm going to update the numbers for you this morning. Our global strategy mid-year outlook was released a day ago, so I want to make sure you're aware of some of the changes. So the key implications from that mid-year outlook is that the positive operating leverage that we've seen prior couple of years in our view, is behind us. And this is a result of deceleration in margin compressions, slowing top-line growth. The Fed is committed to slowing the economy. And this is against the backdrop of inflation, which has really been absent for 40 years, and also a Fed that's turned quite hawkish very recently. And we continue to believe that although the market is sold off, and we're probably approaching a bear market in most of the major indices, is that it is not yet priced in. When you think about the margins, wages are starting to move up, cost of goods sold are moving up, so profit margins at corporations are starting to roll over. And the data that we look at, earnings revision breadth, it's all just starting to show up in that information. So as a result of this mid-year update, we've updated our earnings forecast, and for 2022, we have an 8% growth expectation for S&P 500 earnings. The consensus is 10%. For 2023, our forecast is up 5%. The consensus is 10%. And then for 2024, our forecast is flat, no growth in earnings, and the consensus is about 9%. So in the middle right, we've updated our price targets for our base bull and bear case. And our base case is now, its earnings base case would be $236 16.5 times gets us to about 3,900, which coincidentally is about where we're trading today.
Exactly.
And our bull case gets us to 4,450 with higher earnings, of course. So 14-15% upside. And that would assume a soft landing is achieved. Consumer confidence starts to rebound. Inflation starts to fade. Supply chains reopen in an orderly fashion. And corporations are able to maintain their pricing power. That gets us to the upper end of the range. The bear case is about 3,350, and that effectively assumes a recession. So those are the new numbers and targets, and just please keep in mind that those are targets. It probably would be more realistic to put those in a range. It's really hard to pinpoint any particular point in the cycle. There's too many variables, but we do need to be, our views need to be wedded somewhere, and that's why I wanted to share those with you today. The last slide I'll review is the slide on 17. I mentioned this at the start. This is the classic 60-40 portfolio, 60% of the portfolio in stocks, 40% in bonds. It's what a lot of retail investors have. Most institutional investors have a much more complicated portfolio, but it's sort of been a guidepost in the industry for a long time. And you can see going back to 2006, we certainly had periods like the Great Financial Crisis in 2008, 2009 where it didn't work. That was where the markets were effectively pricing in a depression scenario. Last year that balance was 15%. It's worked pretty well for the most part for a long time. We lost this in the first quarter. We did not have the stability of the fixed income in the portfolio that we so much rely on for portfolios like this. Brian mentioned that rates seem to be stabilizing here a little bit, so we're hoping to get that footing from the fixed income part of the portfolio back for the rest of the year. So I'll stop there unless you have any questions. Otherwise, I will turn it back to Brian. We want to talk about portfolio manager performance.
Great. Well, with those rosy comments, I think before I get into the results, let me just have you turn to page 29 if I could. As we talked about, markets go up and down, and it's really difficult to time the market because the future really is uncertain. And we could have every rationale for thinking that the future is going to unfold in a certain way, and yet we get a curveball, and that turns out not to be right. So we tilt portfolios in directions of things that look compelling and away from things that look a little bit expensive. But what you won't see us do is make significant changes to what our long-term strategy is. And the reason for that is because we could be wrong. Because tomorrow, Russia can say, oops, we made a mistake, and we're going to go back home. Markets are going to rally. A month from now, or a couple of quarters from now, the Fed could say, oops, we tightened too much, we're going to take our foot off the brake. Markets are going to rally significantly. So we come up with a long-term investment strategy for a reason, and that's because over a long period of time, it's going to help us pay the liabilities we have with a limited amount of risk, and the portfolio that we have in place reflects the overall risk tolerance and of the board, and so that is our starting point. And I will just say, in round numbers, we're at 70% equities, 30% bonds, is what our long-term target is. Now, if we become concerned about markets like we are today, we're going to underweight stocks a little bit, but we're not going to go from 70% to 50% for fear of being wrong. So, In our view, things happen in the markets and they present opportunities once things start to settle down. And it's the changes you make during periods like this that we think help us recover more quickly than if we just stayed at that long-term strategy. That is going to help us to recover some of the declines that we experienced on the investment side more quickly than if we just stayed at our long-term strategy. So we haven't been sitting around letting the market do to us what it will. We have made some changes to the portfolio. And I've outlined, what is there, a handful of things here on page 29. I would say the overriding principle to all of the changes we've made is to de-risk and to get more conservative. So what did we do? First thing we did was we reduced our exposure to large cap US stocks. We're slightly underweight our 70% target. So we're at about 66, call it, percent stock exposure relative to our 70% target. Now that relative positioning up until the last couple of days didn't work because bonds were down just as much as stocks. But as we talked about, at least here in the early part of May, bonds are providing a little bit of ballast there. So we're underweight stocks. Second thing we did was we increased the use of value-oriented investments. So things that, companies that pay dividends, companies that don't have as high of a multiple in the market as some of these high-flying tech stocks. So that's a way to get a little bit more conservative. We added a small allocation to real estate investment trusts. They pay out a lot in income. And so anytime you can generate income in the portfolio, those are real dollars. You have that in your pocket as opposed to hoping something goes up in price. So that's a way to get conservative. And we added some, we reduced some of our exposure to some of the active managers to put more into the index funds and passive investment strategies, a way to get a bit more conservative. The third thing we did was similar to what we did in the U.S. equity market. We reduced some of our exposure to our non-U.S. equity active managers, and we increased our use of passive management. We did that in developed markets, we did that in emerging markets. And then the last thing we did was on the bond side, we what's called extended duration. Now what does that mean? It means we bought more longer maturity bonds. And that might sound counterintuitive to what we've talked about with interest rates rising. When interest rates go up, the longer maturity bonds you hold go down in value more than the short maturity bonds. But we think, in terms of the overall opportunities in the capital markets, the big move that Jim and I have talked about in interest rates, we think we're largely through with that move. Might rates go a little bit higher? Yeah, they might. But are they going to go up 20 times on the 2-year from where we were a year ago? Not from these levels. So we actually think there's more interesting opportunities on the bond side right now than there is on the stock side. So we lengthen the maturity of our portfolio because in our view, interest rates are as likely to come down as the economy continues to slow as they are to continue to go up. So again, in the early part of May here, the first week, interest rates have come down. That positioning has helped us. So it's these changes that we do as markets evolve, which might protect some capital if things continue to go down, but when things turn and markets start to recover, we would expect to recover more quickly. Any questions about that? I'm going to come back to slide 28 here, because this is very relevant when we start to talk about performance. But we've been active. We look at this stuff all the time. How are we positioned? Is there something we should do differently? We're not going to make a change simply for change's sake, but if there's reason to do so, we have the discretion and authority to do it. We're going to do it. Yes, sir.
Do you think the trend that I noticed on slide 29 to passive investments is a trend going forward even after we get past the situation?
No question. So we're in an environment where it should be favorable for active managers. Active managers, while we talk about what's the environment you do best in, well, we need volatility. Well, we've got volatility. It is our expectation within this portfolio, as things recover, we are going to move more and more out of active management and more into passive. But we're not going to do it right now because we think, despite what the most recent past looks like, we think we're in an environment where active managers should be able to add value. Let's go to slide 33.
Do you have anything in here that shows the split of active and passive, or roughly how much is active?
Slide 35, upper right. 80-20.
But about 20% passive.
Okay.
Over time, that will go up, and fairly significantly. Page 33, here are the results. Again, this is for the first quarter. I'll give you an update as of, well, through yesterday.
Brian, did you finish 28?
I did, yeah. I'm going to come back to 28 when we talk about performance. Sorry. Page 33, when the rubber meets the road, how did we do? Well, we went down like all capital markets went down. We were down 7.6% in the quarter. We underperformed our benchmark, which was down about 5. Yeah, that's a disappointing number, clearly. But putting a 7.6% decline into a little bit of context, we were up 12% last year. Didn't give it all back through the first quarter. We gave a good chunk back. But markets last year were at very high levels, and now we're starting to see the pullback. How have we done in the second quarter so far? Well, I wish I could tell you it's gotten better. April was a really tough month for equity markets. We've gone through it. Equity markets around the globe are down, call it anywhere between 15 and 25%.
It's not 10 o'clock, I guess.
Second quarter to date, we're down mid to high single digits. It's right in line, slightly better than the benchmark. So it's reflective of everything that's going on in the capital markets. Again, we've made some changes that are starting, we think, to pay off, and we'll see how the rest of the year goes. Mark, to your question earlier, you see on slide 33, since we took over in April of 2016, $94 million from investment earnings. And you can see that's the lion's share of the change in market value from when we started at 88 million to roughly 226 at the end of the first quarter. Return since then, slightly behind the benchmark now. We had built up significant excess returns relative to the benchmark, and the last 12 months have been a struggle for our managers. Now, I'm going to come back to page 28. Why has it been such a struggle for the active managers we use in this portfolio and, quite frankly, across all of our other clients? There's a chart, there's a heat map on slide 28 on the left-hand side. This looks at different characteristics of companies that make up the broad equity markets here in the U.S., developed non-U.S. markets, and emerging markets outside the U.S. There's this factor called quality. And what does that mean? Quality is, think about companies that have strong brands, that are well known, that have stable earnings profiles, that are growing their revenues, that have good management teams and low levels of debt on the balance sheet. Those are characteristics of quality companies. Those are the exact companies that worked really well during the pandemic and were the worst returning stocks so far this year. Our portfolio has a lot of that stuff, a lot of these good companies. It sounds silly to say we want to buy good companies, good quality companies. We don't want to buy junky companies. But it's that factor of those good quality companies, stable earnings, strong earnings growth, good management teams, low levels of debt on the balance sheet, that were the absolute worst performers this year. That's what's dragging our return down below the benchmark. Over the long run, those are the companies you want to own. But you can get in very discrete short-term periods where it is a factor that doesn't work. And that's what we're going through right now. And that's why we don't want to move significantly to the index right now, because we want to maintain that exposure to those high-quality companies, particularly if we get a significant slowdown in the economy and arguably enter into a recession. Those companies are going to shine. And so will this portfolio. Any questions about that?
Brian, of those companies, which ones would you label growth stocks? Because
a lot of them. But things like...
Good companies, but expensive.
Yeah.
And some of them aren't even that expensive anymore. Microsoft is always thrown out there as the poster child of, the high quality company. It's trading right now about 30 times earnings. Yeah, it's a little pricey. It's more pricey than the overall market. But that stock is down, probably with yesterday, down 25% this year. I would argue, and they reported earnings in April. They're having accelerating earnings growth, particularly in their cloud business, which everybody is focused on. Why on earth is the stock down 25% when they're experiencing accelerating growth, up their estimates for the rest of the year, and yet the market doesn't like it? So anything that has a profile of technology, even if they have real earnings. There's a lot of parallels that people are drawing right now between what's going on in technology stocks versus what happened in 2021. I can tell you that those periods couldn't be more different from one another. 2021, when the TMT bubble burst, you had companies, oftentimes, most of them had no earnings, some of them had no revenues, and yet they were trading at $1,000 stock prices. Today, you've got real companies that are generating revenues, oftentimes that are paying dividends, that have strong earnings, growing earnings, and they're taken out behind the woodshed. But it's those companies over the long run that we want to hold, because those are the companies that outperform the market. Hopefully that answered your question. It's a lot of it. A lot of it is the growth versus the value. Any other questions about that before we get maybe into a little more specifics on the portfolio? Yep. Okay. Let's skip ahead quickly to slide 34. I sort of mentioned this. We're slightly underweight stocks. You can see that on the left-hand side of that pie chart. 66% equities versus our 70% target. Slightly underweight fixed income. On the alternative side, because we've added those REITs get picked up here, we're right at our maximum that's allowed, which is 10%. Slightly overweight the 8% target. I'm going to talk about this because this is the alternatives piece has been the one shining spot in the portfolio.
Does this reflect these changes that you said on the other page?
It does. It does. Yeah.
Based on the way you're describing it, I would have thought you'd be a little bit overweight fixed income.
Well, we've extended duration.
You've extended the duration, but the allocation
hasn't changed.
Allocation is a little under, but you got longer duration. So
so we're getting more bang for our buck there.
More exposure, I guess,
Yep.
to rates.
Yep. Okay. Let's move to slide 37. So this is the attribution analysis for the quarter that we oftentimes walk through. We start on the left-hand side with the benchmarks return. Again, this is for the quarter. Benchmarks return was down 490 for the quarter. On the far right-hand side, we were down about 7.5. There's 3 different factors that contribute to whether we outperform or underperform that benchmark. We can be over or underweight stocks, bonds, or alternatives relative to our targets. That's this broad allocation effect. It added a little bit of value, 10 basis points, nothing significant. That's not going to be a big number for us because we don't make significant bets to over or underweight stocks or bonds. At the margin we do, but not big bets. The sub-allocation effect is within equities. Does our portfolio look different than the broad market? Within bonds, does our portfolio look different than the broad market? Are we overweighting small caps and emerging markets or developed non-US? Do we have more longer duration or shorter duration? That gets captured in the sub-allocation effect, so it was a slight detractor. So you add those 2 components together, they're basically a wash for the quarter. All of the underperformance coming through from what's called selection effect, down 250 basis points. That is the managers we have underperforming their respective benchmarks. I'll tell you in the year-to-date period, we have 12 active managers, 8 of them underperformed. And it's all because of this quality bias. When you look over the since inception period, which is from 2018 is when we had discretion. We began working together in 2016, but since 2018, since we had the authority to hire and fire managers, 7 of those 12 have outperformed. So it starts, once you extend the measurement period beyond this, I'd say unusual, but this stuff happens a lot more frequently than the models will tell you, but in this volatile environment, when you extend the measurement period beyond this volatile environment, you can start to see that things work over the long run, especially this quality bias. We're going to come back to the public markets managers in a second, but I just wanted to comment on the alternatives. So as you know, we have an 8% target. We can go up to 10%. We're right there at that maximum exposure we're allowed to have. And what is the composition of that 10% of the portfolio? We've got a couple of hedge funds. We've got a couple of real estate managers. So one of our hedge funds is a firm called Corbin. It invests in, you think about it mostly as private debt securities, companies that they lend money to directly as opposed to going out buying their bonds. It's flat on the year through April. Pretty good given the declines that everything else has had. Another one of our hedge funds investments is a firm called Graham. Graham is a macro-oriented trader, so they follow the trends in the market and they move the portfolio and things that are working and things that are not working they don't have any exposure to. They're up 13% through April. Worked really well. Renaissance, which is kind of a long-short equity manager, struggled in 2020. Last year did better. This year they're up 5%. So again, 5% is not a huge number, but when everything else is down 20, 5% is pretty good. Our 2 real estate managers, there's a firm called Oak Street that we've got. They're up, their numbers through September of last year, because we don't have any updates yet, 22% in terms of the exposure we've got there. And then a core real estate manager, which goes out and buys apartment buildings, industrial complexes, some office buildings. We're up 8% there. So the alternatives are really working for us. We can't have more because of the liquidity profile of the fund here. We're paying out $20 million or $30 million a year in benefit payments. Can't really tie up much of our capital in these kinds of strategies. But what we've got is working. And it's helping, believe it or not, even though we're down, right? But it's been a nice addition to the portfolio that we hadn't had historically. So I wanted to make sure that I called that out specifically. Let's turn to slide 48 and 49. And there's a lot of numbers here. I kind of gave you the highlights. I'm not going to go through each of these portfolios, but this quality factor that has been the absolute worst place to be this year is pervasive in a lot of the active managers we have. So it's not a surprise to see our active managers underperforming in light of those kinds of companies underperforming. But over the long period of time, we have more that are generating excess returns than those that are underperforming. And then I guess the last thing I would say is on the bond side, through the first quarter, and these are shown up on the bottom of slide 49, our managers were down, but our managers went down less. So this quality factor, all of its concentration within the equity positions we have, really driving all of that underperformance. So with that, I'm going to stop. I don't know, Jim, if you had anything else you wanted to add, see if there's any questions. Despite what's going on, we again, as we talked about, we're encouraged that bonds are starting to hold their value. They're not going down with stocks each day as the stock market continues to go down. We have exposure in companies and managers that we have a great degree of confidence in. We never expect any active manager to outperform in every single environment, but over a long period of time, we have every expectation they will, and we still do with those managers we hold. And I think with those changes that we made and landed, we implemented those changes, I would say in the first half of March is when we got a bit more conservative. We extended duration on the bond side. Didn't work in April, but it's starting to work here the early part of May.
Brian, the plan is to stay with the active managers because of their quality stocks that they own right now, in the hope that they're going to rebound in the near future and then move more towards passive.
Correct. Right. We'd like to see some of that outperformance, and we think that will happen as the economy continues to show signs of slowing. At that point, when the economy is sort of, showing signs of recovering from that slowdown, is when we're much more likely to start pulling back on some of that active exposure. Whether that's next year, 2 years, or 3 years down the road, hard to say. But that's the playbook, so to speak.
Is the whole active passive thing strictly a product of the environment that you think we're going to be in versus less chance of active managers outperforming, or is this sort of a shift in strategy that you think there's a higher chance of you adding value at the sort of allocation versus the security selection?
We still think there's value to be had through security selection, and we're always going to have exposure to active management because over a long period of time, the ones that we gravitate towards have tended to outperform. But we do think and recognize there are discrete periods of time within that long-term window that active managers struggle. And they tend to struggle in periods when equity markets are rapidly rising. Now, it just so happens they're struggling now because of this bias that they have in their portfolios with quality companies. But in general, active managers tend to outperform in falling markets. We just haven't seen that, not only with this managers, but across the board.
It's funny, like, saying it that way because most of the time markets are going up.
Well, that's right. And
so it's like most of the time they're going to underperform. I don't think that's true, but based on what you said, if they most likely perform better in down markets.
Well, I think there's two periods. One, when active managers will tend to underperform when there's a rapid shift in the economy, very difficult for them to turn the portfolio because they have no idea where the economy's going. And then in an overheating economy where things start to get speculative and there's melt-ups, and the lowest quality, they tend to underperform. Those tails are bad outcomes for active managers. It's our expectation that when things just start to normalize for active managers, there should be a pool of great companies to buy because there's indiscriminate selling happening now. And so, and if there's concerns about a recession or slower growth, that should lead managers back to quality companies where we think we'll start to pick up that alpha or that outperformance. And then we'll evaluate the passive active ongoing. Right? If we're converting to passive, it should be a period where you're saying, why are you selling these great managers? Not a period where the managers are underperforming and they're underperforming, so we've lost confidence, so we're going to move to passive. Just the opposite.
Thanks.
Question.
So with that, your formal presentation is done.
Yes.
Anybody else want?
I just wanted to highlight that there is a package from John Hancock that, has this interesting statistics, on the number of people in the system and that kind of things. And as you know, they process and make payments to the beneficiaries. They handle all that administrative side of the house. And the only other thing that I wanted to bring up is I'm suggesting that we will draft the June 7th council briefing and circulate it for comments. We really don't have that much time. It's less than a month, so.
I'll get you my slides next week.
Okay, well, you can wait if you, more recent information is always good.
Yeah.
And we'll get Andre to do something, and it will.
I wish the timing of the meeting was different, considering that the markets have not been kind.
Yeah, but they're not going to get better in the short run. The city code says we're supposed to do this once a year, and we're late a little bit, so. We needed to get it done, and the budget's adopted, so they're not going to be distracted by that. So, although there's going to also, I think we're doing another briefing as well. I can't remember if it was on forensics audit or if Davenport is going to come in to talk about the city's debt in general. So we'll have other things going on, but we'll make it as easy as we can, which would be different than the detail, I think, that we would do at these meetings.
Sure.
Okay.
I think your slide, what was it, 29? The one that talked about the strategy would probably be very relevant,
Okay. Yep.
among others.
Yep.
The only other thing I'll say is just, thank you guys for looking after the money. I know this has been a hard, quarter for sure, and maybe a little bit longer than that, but I still have confidence in you guys.
Thank you.
Thank you.
And fingers crossed that the moves you make will be to the benefit of the participants in the city.
Like Jim said, this is not the place to sugarcoat. This is the place to be the real deal.
So, fortunately, you can't win all the time, which we would love if you could.
So
but
would
it's not
we.
realistic.
Great. Thank you for that.
Yeah, a lot of things are going yet to play out.
Yep.
All right.
The next, just forget, for those who are able to attend, June 7th is the city council. And then our next regular meeting is August 11th. And we are planning the retirement board annual meeting for the November meeting. So that will just simply to have the slate of officers.
Will the council presentation, will that be work session or during general meeting?
It should be at 5 o'clock in a work session.
Work session, because that's much earlier than some people.
Right, and then
Anticipate.
we can go home after that, yeah.
All right, meeting adjourned.
Thank you.
Very welcome.